Okay. It's
Fantastic.
recording.
Fantastic. Well, welcome everybody to this impromptu little last minute value packed session that we're putting together to save ourselves a bunch of money before the end of the year. Now, one of the things that I've noticed is as long as I've been running a business, it always is about this time of the year where I start freaking out and thinking, gosh, is there anything that I can do? Is there anything I should have done? And I'm bombarding my account with a bunch of questions. And so I asked Jim Chaston to come and join us today. And he has been helping small businesses handle and tackle all of their tax challenges for over 20 years now. And he's got a master's in taxation. So he is the smart guy. He's got all of the information that we need. And he, according to him, he said there are still some things that we can do before the end of the year to save on our tax bill. So with that, I am going to turn this session over to Jim, and he's going to help us save a bunch of money on our Christmas presents. Right, Jim?
That's right. Thank you. Yeah, and good afternoon, everybody. Yeah, my name's Jim Chaston, and I'm starting my 20th year of owning my own business, and actually my 33rd tax season overall. So she was being nice because I'm getting older, 33 years. We'll start off here. I like to have fun. It's right at the end of the year, so I'm probably going to tell a few jokes here and there. And we'll start off with one. I don't know if any of you are attorneys, but what's the difference between an attorney and an accountant? The accountant knows he's boring. So there you go. We'll start that off with that. And as we move, we're going to go.
I should have set up my little drum roll.
Yeah, boom, boom.
Sorry about that. I was
no worries. No worries. So the topics that we're going to talk about right here, I've got, you got to start off with a disclaimer. I'm going to talk about what not to do, what to do, areas of IRS focus for 2023. If they actually get all 87,000 IRS agents hired, this is what they're going to be focusing on. And then some planning tips and tricks that we didn't already talk about in the what to do. That didn't turn out very well, but this is an IRS tax refund calendar based off of when you file your return, when about 90% of those that filed during that week can expect their refund. So in here, if you file between February 26th and March 4th, not that you can read that, you can expect a direct deposit refund on March 24th, I believe that is. And if it's mailed, it's March 31st. So that's the kind of the schedule. It's about 3 to 4 weeks out is what they're saying. I'll believe it when I see it because the IRS is completely overwhelmed at this point in time. As we go through, you know, we've got the CPA, the certified public accountant, who is someone who does precision guesswork based on unreliable data provided by those of questionable knowledge. Is he also a wizard and magician? I feel that way many times when my clients bring me information or the lack of information. So we're just going to have a little bit of fun. My disclaimer is, so this presentation is meant for in general information. You may have a very specific situation that may warrant a completely different approach than what we're going to talk about today, and different actions you may need to take. But this is in general, based off of, we just want tax savings for this year, and next year, you're going to have basically the same amount of income. It's not if you're looking to sell your business or apply for loans in the next 2 to 3 years, as you actually would need a different approach for those things. But so in general, that's what we're looking for. Your specific situation, make sure you talk to your tax professional. Here's the joke. I understand where you're coming from, but I don't think the government will recognize your brother-in-law as a charity. Yeah. What not to do? Well, that was one thing. What not to do? I hear this all the time. Hey, you know, my buddy, my plumber, they told me I can do this. that I should make sure that I take advantage of this to save taxes. My question is, was it from a CPA or a tax professional? Stop at that point in time, stop listening to them unless you want to share a cell with them. You know, just because they like to drive 95 on the freeway and didn't get caught doesn't mean you won't get caught or that it is legal. Same goes with those tax tips to save money. Sometimes they're okay, but sometimes they're not, and that person just didn't get caught. So make sure you're talking to a tax professional, not your buddy or brother-in-law or the guy at the bar. My number one pet peeve this time of year is buy a truck or a vehicle to take their tax write-off. Stop it. Don't do that. That is my number one pet peeve. That is what a car salesman is trying to sell you to buy a truck or a vehicle. Now, buying a truck or a vehicle is not a tax decision. It's not a tax decision. It's a financial decision. Number one question, do you need a new vehicle? That's the question you should be asking before you buy a vehicle. Now, if it is a matter of, do I buy one now or do I buy one next summer? That's a tax question. And depending on what your income is, if your income's up, so forth, then it's okay to buy a truck or a vehicle. But I'm not going to tell you go out buy a, you know, I was going to say $50,000 truck, but you can't find those, you know, $95,000 truck now. If you need a new vehicle, then it's a matter of timing. The timing of it is a tax question, not the actual purchase of it. Yeah, don't go spend a whole bunch of money when you actually don't need it. And that goes with anything. If you don't need it, don't go buy it. I don't want you spending, you know, $50,000 on something that you really don't need to get a $12,000 or $15,000 tax write-off. You're still out $35,000 to $38,000. That's not good financial sense. Make financial decisions before you make tax decisions. That's basically what it is. And then the other thing is, you think that what applies to somebody else applies to you. You may have a very different situation. So you can't just go applying, you know, what somebody else tells you. You got to make sure that it actually makes sense for you. That's what not to do. You know, a lot of people have heard about this, the new filing requirement for $600. It's a little joke. IRS agents slide down chimneys looking for gifts of $600 or more. Because you got to pay tax on anything you receive that's $600 or more. It is kind of a joke, but not really. Yeah, that's kind of where we're at. So if people are selling things on Amazon or Etsy, and they have any, you know, they're set up on PayPal, if you process more than $600 this in 22, you're going to get a 1099 now, even if it's just stuff out of your garage that you technically don't have to pay taxes on it because you're not in the business of selling that. You're going to get a 1099K for $600, and you're going to have to deal with that on your tax return. If you get one, you know, talk to your tax professional about how to handle that, because it's got to get filed, but it's not taxable, and there's some tricky things in there. The IRS is out there. I mean, with all of the money that the government has given away the last 3 years, trillions and trillions of dollars, well, they're hiring 87,000 agents to go recoup it for taxes. So they're going to be looking at everything and make sure that you're doing things right. What to do, or what to know, actually. What to know is make sure you understand your business, know what's important to you. I mean, some of this is mindset stuff, but make sure you understand what goes on in your business. And then mindset. You know, would you rather make $500,000 and pay $100,000 in taxes, or do you want to make $100,000 and pay $15,000 in taxes? Yeah, give me the $500,000. I'll pay the taxes. But every day I hear, no, I want to pay the $15,000 in taxes. No. Give me the 400 net, not the 85 net. So make sure you got the right mindset of being successful, making more money. Yes, we're going to pay more in taxes. That's not a bad thing. That means you're successful, you're doing things well. What are your goals? Go after your goals first, taxes second. Don't let the tail wag the dog. We're taught financial decisions first, taxes second. And is it about success or is it about saving taxes? For most business owners I know, it's about being successful, not saving taxes. And I've seen people give up being success because they want to save money in taxes, and they get in cash flow binds and all kinds of things because they're spending their money here and there, and then they don't have the cash flow to grow their business like they want to. So it's about your goals. It's about success. Saving taxes is last. Now, I will say we're going to be talking about paying the least amount of taxes at that income level. So I don't want to say, you know, if you make $500,000, I don't want to be paying $160,000 in taxes. We want to be paying $100,000 in taxes. And so that's what we're going to talk about, is paying the least amount of taxes at that success level. Little joke here, you know, none of this makes any sense. It's almost as if they don't want me to understand. Well, maybe that's why they call it the tax code. It's a code. It really is. And I'm going to tell you that. Now, what to do? Understand your marginal tax bracket and where you stand in the tax bracket below you and the tax bracket above you. So there's a number of different tax rates. Starts out at 0, then it goes to 10, then to 12, then to 22, then to 24, to 32, 35, and 37. There's 7 tax brackets. And you hit each of those at a certain income level. So, and it depends on if you're single or married, you hit those at a different bracket. But let's say you're currently in the 22% tax bracket. And you can make another 30,000 until you hit the 24% bracket, or you're about 50,000 above the 12% bracket. So what that means is when we're doing planning, depending on where you want to be, is you can come up with $50,000. If we can come up with $50,000 of expenses, you're going to save 22% on that first $50,000 of additional expenses. If you go past 50,000, then you drop down into the 12% bracket, and you're only going to save 12% on each additional dollar of expense. And so when we're doing that planning, I don't necessarily want you to reduce your income by $70,000, because I'm going to tell you right now, at 12% tax bracket on that last $20,000, let's push that to next year and save at the 22% bracket on that $20,000. You're going to save 10% by making sure you know what marginal tax bracket you're in for that year and the next year. That's really important to understand. Secondly, if you're already spending money, how can we convert that to a deductible item from a non-deductible item? So, you know, if you're paying for internet at your house and you have a home office there now, or you put in a home office, that internet now becomes a business write-off instead of a personal write-off. You didn't change what you were spending, but now you can write it off and save tax dollars. Those are the things that we want to talk about. Sometimes got to be a little bit careful with this, especially documentation and terminology. Not necessarily a vacation, but if you go on a seminar where you attend a seminar in a different city, and the main purpose of going there is for business reasons. You go to a seminar in Hawaii or San Diego, the travel, the hotel, the car rental, meals, and all of those can now be deductible. Whereas if you just went there personally, none of it's deductible. So it's converting things that you're already paying into a business deduction to save tax dollars. It's not about spending more money to get a 22% or 24% tax write-off, because you're still out 75% of the money. And as an accountant, I'm a little tight, so it's about converting those. Additionally, if you're having a really good year, you can actually write off anything that if you're cash basis taxpayer, which most small businesses are, almost all of them are, you can prepay 12 months worth of expenses and write them off now. So if you've got a really good year and now, you're in the 24 or 32% tax bracket now because your income's up, well, you can prepay 3 months worth of rent, 3 months worth of cell phone, 3 months worth of advertising, 3 months worth of utilities, 3 months worth of whatever, professional fees, etc., and write all of those off in December. Then that drops you out of that 32% down to the 24%, and you just save 32% federally plus 3% Arizona, 35% total on all of those expenses. But your cash flow, because it's for January, February, March, gets replenished within 60, 75 days. So you're not really out any cash flow. You just get a deduction right up front and reduce your taxes. And then you can do that each year. If you have a bad year, you drop that down and don't do it because you're in a lower tax bracket. So there's some good tax planning you can do that way. Additionally, deferring revenues, delay your year-end billing. Your December billing, send it out right at the end of December or in January. So you've got whatever, those billings are, you can defer those into January. Now, I will not recommend you do that if you're having cash flow issues, because again, financial decisions come first over tax decisions. So you've got to make sure you got the cash flow for operations, etc. However, this is a way of doing that. If you're in a bad year, you may want to do the reverse of it. Delay paying expenses into January if you believe that the next year is going to be significantly better. You can buy equipment. Again, this goes back to the financial decision. Do I need that piece of equipment? And if you do, then when do I buy it? Do I buy it next year? Do I buy it this year? Inventory, to a certain degree, depends on if you're cash basis, accrual basis, but inventory, supplies, you can buy all of those things and stock up in December. And because you spent the money on them, you can write them off now. And then you don't have to buy those for the first 6 months or 3 months or however long period of time. And you replenish your cash, fairly quickly with all the prepaying of those items. And then retirement plans. I really like those, especially if it's a single person owner. It's basically just putting cash in from one pocket into another pocket, but you get to write it off. You're not out the cash, it's just from one pocket to another, and you get to write the money off. All right, so yeah, heard any good jokes lately? Yeah, tax relief. That is a good joke. We haven't had any this year. We did in 20 and 21. There is nothing this year. And taxes are anticipated to go up over the next couple of years. Not a good joke. Things to consider. Analyze your choice of entity, S Corp, C Corp, LLC, for partnership, sole proprietorship, etc., and which one might be better. You're going to want to talk to a tax professional about your specific situation about that. The administration cost, all of the different pieces, but going from a sole proprietorship to an S Corp, if it's the right situation, yeah, it's, 5-figure savings on an annual basis, 10,000 plus and on up. So definitely think about that. Cash versus accrual method of accounting. This is actually a big deal, and just a quick story about this, and hopefully I don't go long, but I've got a doctor client who switched from the traditional method of billing to concierge, which basically means their clients, pay a set dollar amount monthly. They're or annually or monthly. And Then they can see the doctor, they can call the doctor anytime. And the doctor doesn't take insurance anymore. It's just they pay a monthly or annual fee and they can contact the doctor whenever they want. Concierge method. Well, they switched this year and the doctor's got about it was $315,000 of prepayments for the months January through June. Cash basis, because the doctor brought that money in, he's got to pay tax on that extra $315,000 over and above what his income was the prior year. And so, that's going to push him into the, 37 plus 3 plus state of 3. It's almost a 45% tax bracket for that $315,000. However, if we switch to accrual method, because that is income for January, for services he's going to provide in January through June, doesn't have to recognize it until he provides the services. So we're actually really looking at switching to an accrual method of accounting. It also affects payables. So, you can't prepay for things that you're going to get the service of in the next year. So you got to do it for both income and expense. However, we're looking at saving about $120,000 in taxes by switching to accrual method instead of cash. So it's something to think about if that is your situation. Next item, make tax advantage section 179 real property investments. What this is when you make real property investments, real property is buildings. And so you do a renovation on a building. Generally, you have to depreciate that over 39 years. They change the life on some of those improvements to 15 years, and you can write it all off in the year that you do it. And so there are some businesses you can do a renovation on your building and write all of that off in the year that you do it instead of depreciating over 39 years. So it's something to look at. Definitely. For sole proprietors, this doesn't count for S Corp, C Corps, partnerships. It's only for sole proprietors. Looking at hiring your spouse and or your children that are under the age of 18. You hire your spouse so that you can get some fringe benefits. Your spouse gets health insurance through the company, and you can get fringe benefits through your spouse and set up health reimbursement arrangements, etc. You can pay your minor children without having to pay Social Security on them if you're a sole proprietor. There's some benefits there, so think about that. Again, establish a small employer health reimbursement arrangement if qualified, similar to what I was talking about with this hiring the spouse. Reimbursing S Corporation shareholder home office. You can't pay rent. However, the S Corporation can reimburse the shareholder based off the actual costs of the home office. It's similar to setting up, square footage, and you break it down by square footage, the home office versus the whole house. So it's a similar calculation, but it's a reimbursement to the S Corporation shareholder. Here we go. Why did Sherlock Holmes get audited by the IRS? He had too many deductions. It's not really a joke. I've said this many times over many years: pigs get fat and hogs get slaughtered. Too many deductions, too much of a good thing is not a good thing anymore. So make sure that you're doing things appropriately and not taking advantage of this, of the tax system. And where that line is, talk to your tax professional. Some things to consider: you can, in partnerships, you can deduct unreimbursed partner expenses on the personal return. Make sure that that's happening. Reimburse mileage for S Corporation shareholder. You don't pay actual expenses. You reimburse mileage for a shareholder-owned vehicle. What this says here, and unfortunately you can't see it, but you got Santa there with an accountant and you've got the IRS office in there, and they're talking about this should be a snap. The accountant for some guy named Kay Kringle claims he racked up 3,562,000 miles of business travel in one night. So where I get this is I get realtors telling me they drove 75,000 miles. We got to have documentation. I'm going to tell you that. So it's got to be somewhat reasonable, or you better be able to document it very well. Maximize section 179. 179 is you buy equipment and you write it off in the year of purchase instead of over 5, 7, 10 years. We're getting into some, if you've got a partnership and a partner dies or sells their interest, there's some things under code section 754 for partner owner changes that you can get some really good tax benefits. Talk to your tax professional. We're getting into some technical issues here, similar to section 338. If you're S corporation stock purchases, again, somebody dies, they get bought out, you can take advantage of asset sale rules instead of stock sale rules. Talk to your tax professional on that, but it's something to consider. And then similar self-rental opportunities. If you own a building that your business is in, make sure that you're using fair market value rents on that. And there's some good reasons, some tax savings. You're making some of that rent active instead of passive to avoid some of the passive losses that you want to be able to take advantage of. All right, here we go. This return looks mighty suspicious, Irv. This family spent less than they earned. So yeah, couple things here. Things to consider: tax credits. Now we're not talking about deductions. Now we're talking about credits. Difference between a deduction reduces your income, and then you pay a percentage of your income in tax. Credits reduce the tax amount owed. So it's already after you calculated what the tax is based on the rate, and then it reduces the amount of tax. So they're significantly better. There's a new pension plan credit. There's fuel tax credits, work opportunity credits, which are if you employ people in poor areas, they have to be in a certain area, you can get a tax credit for wages you pay them. Employer tip credit for restaurants, business energy credit. Again, this is solar alternative energy that the business can get in addition to similar to, solar on your house, you put solar on your business. Rules are a little bit different. Same with alternative energy. Employer provided childcare credit. If you have an in-house childcare center, you get a 25% credit for qualifying expenses to help offset those costs, and the disabled access credit for putting in handicapped and better access for people that are disabled. Take advantage of those credits. The big credit that it's on everybody's mind is the employer retention credit. It is a fantastic credit, and it is, man, the fraud on this credit is rampant. You're hearing everybody talk about this employee tax credit up to $26,000 per employee, and it is a fantastic credit. And my guess is about 75% of what's being applied for is fraudulent. The big ones that I'm hearing, so here's the credit. Here's the credit is during COVID, if you retained your employees while you were in a hardship, the IRS in the year 2020, I should say Congress, not the IRS. The IRS administers it, but Congress passed the bill. Gave you a 50% credit for the first $10,000 paid to an employee during the year of 2020. That wasn't where those wages weren't paid for by the PPP credit, the PPP loan that was forgiven. So you can't double dip on wages that you paid using the PPP loan. So this has to be over and above that. So if you used up all your PPP loan money by September, then any wages, October, November, December, you can use the employee retention credit. Up to $10,000 per employee, 50% credit. You've got 3 years to apply for that credit. Then in 2021, and some of the qualifying things are you had to have a shutdown, a government mandated shutdown or partial shutdown. A lot of businesses did, especially here in Arizona. But you only get the credit for the time period when the shutdown was in place. So if you were shut down from April to June and you paid your employees during that time frame, normally the wages paid during that time frame, April to June, would be covered by this employee retention credit. However, if you used PPP loan money to pay that, well, you can't claim it then. And now in July, you're not in a government shutdown anymore. So you don't qualify for it. Second, another way to qualify is that you look at it's quarter by quarter. So we're going to look at third quarter of 2020 versus third quarter of 2019. And if you, well, actually 2020, I apologize, is annually. No, it's still quarterly. If you had yeah, I know, going back and forth. The problem with this is they've changed provisions of this credit 9 times since it was originally passed. And so that's the other thing that you hear out there is somebody talked about it, last year. Well, some of the provisions are different now than when they were a year ago. And so if you're doing this, talk to a tax professional, make sure you're doing this. And there's a lot of companies out there, pay me 10%, 15%, 20%, 25% of the refund, and we'll go get it for you. The fear is these are they got created for this credit. They're going to shut down. Then in 3 to 5 years, you're going to get audited. And they're like, yeah, this didn't qualify. Because all the IRS is doing right now, they're not reviewing anything. They're processing. They don't have the time to actually review and verify that it's accurate. They're going to come back in 3 years and do the audit. Then it's going to bankrupt and shut that businesses down.
That's crazy.
If you've got 10 employees and you qualify for $26,000 an employee and you get a $260,000 tax credit, that's really what we're looking at here for some businesses, which can save them. The problem is in 4 years when they come back, you have to repay that $260,000 plus penalties and interest, which is probably another $140,000. So now you have to pay the IRS back $400,000
for that.
Now you're bankrupt. Now your business, you're out of business and you're bankrupt. I mean, that's really what we're looking at here with this credit. However, if you qualify, it's fantastic. It's great. But so it has to be a government shutdown. In 2020, you have to have a 50% reduction in revenues versus the prior year. Basically shut down. Then in 2021, the credit gets really good because it's by quarter, not for the whole year. So first quarter of 2021, you get a 70% credit for the first $10,000 of wages paid per employee for the first quarter. So you can get a $7,000 credit for the first quarter, second quarter, third quarter of 2021. So 3 $7,000 credits, as long as you paid your employees $10,000. That's the 21,000 plus the 5 in 2020, $26,000 potential. And in 2021, you only had to have had a 20% reduction in revenue versus 2020 or 2019. Okay. Now, so if in 2019, your gross revenue was $500,000, then in 2021, in order to qualify, your revenue has to be under 400,000 for the quarter. It's got to be more than a 20% reduction. There are some interesting things in there. If you have different lines of business, there can be some additional ways to qualify. The big one I'm hearing is, well, if you were subject to a supply chain issue, supply chain holdup, that you qualify. I've heard that all over the place. It's not in the law. It's not in the law. Supply chain problems are not in the law. And that's
Jim,
the
do
one.
you think, are there a lot of CPAs who are following that line of thought too? I guess that's my concern.
Oh yeah, CPAs. A lot of CPAs are not doing these because there's huge fraud potentials out there and the liability that is out there. We've done probably a dozen or so. Ourselves, our firm has, and I've got another one that I'm getting ready to do for 2.1 million. But it's a very specific, and we've got all the documentation going all the way through, but you know, it's $2.1 million, and you know, it's on an Indian reservation. The chairman of that nation had government mandated shutdowns, and you can't, you know, get together in groups, and you know, so I have tribal resolutions and executive orders, you know, like Ducey did in 2020, March, April, and May, and June, so forth, and then for different industries. So we've got all of that. But I'll tell you right now, if we have a client that goes out and gets it through one of these fly-by-night companies that are really pushing it, we're not going to be representing those clients in audit. They're going to have to go back to the company that actually did that for them, and hopefully they're still in business.
That makes sense.
Because all of our clients, we already did a preliminary review of the ones that we do the bookkeeping for, and that or payroll for, or that we know. We did a review at that time, and we went out and told those clients, hey, we believe you qualify for this. Make sure you give us some additional information so we can make sure. If we don't believe that they actually qualify for it, I'm not going to go into an audit and say, hey, you know what, we don't think they qualify, which I would be required to say.
Right.
And so it's just it's a bankruptcy event.
Yeah.
If they file for it and the IRS comes back and says they don't qualify. So, but that's the big one that's out there. It's a fantastic credit. Don't let me, but not everybody qualifies for it. And the companies are saying everybody qualifies for it. So, definition of a tax. So a fine is a tax for doing wrong, and a tax is a fine for doing well. Very true. Focus for the IRS. What time how were we at? Oh, we're good. I'm about done. Areas of IRS focus for 2023. They're going to be looking at independent contractor versus employee. So if you are paying workers as an independent contractor, yeah, they're probably coming for you. Because in the state of Arizona actually believes that every worker is an employee, not an independent contractor, unless by state law they are an independent contractor, like a real estate agent, an insurance agent, they're contractually independent contractors. So yeah, they're going to be coming for them. And crypto, virtual currency, yeah, they're coming for that.
Wow.
In 2016, who was the big wallet? I forget the name. Anyway, the big wallet company that holds everything, the big one here in the United States. They said they had 45 million accounts.
Wow.
And 427 people in the United States filed a tax return with cryptocurrency transactions on it. 427.
I mean, I'm no accountant, but that math ain't mathing.
So there's been a lot of changes over the last few years. This year, the virtual currency, the cryptocurrency wallet holder companies
Mhm.
are now required to submit transaction activity to the IRS. So cryptocurrency is considered an equity investment. It's just like stock. It is tracked just like stock. So when you buy it, you got basis, and when you sell it, it's a sale. The problem is Congress hasn't figured out how to deal with the fact that it's a currency.
Mm.
People have it on their phone and they walk up and they buy a $5 coffee at Starbucks or an ice cream. That's a sale of stock.
Mhm.
And if they do this 3 times a day, every day of the year, they have 1,100 transactions, 1,100 sales of stock that they have to report on their tax return.
So, so for those, that brings a good question. So if somebody is using the currency like that in a point of sale situation, does the wallet or whoever's holding their investment, are they giving them an annual report, or what does that mean for the person who's spending the money? I mean, I'm less
They
concerned
didn't
about
until this year,
okay.
last year. And they may require a fee to get certain things out of it, but there's some software, but there's a form and you have to report every single cryptocurrency transaction on your tax return.
Every single one?
Yes.
Oh, that's a lot.
Yes. So this is a big issue
Yeah.
for people. The other issue is, let's talk to a buddy of mine. He's an accountant in Southern Indiana. His client, ice cream shop. She started taking Bitcoin. And first year of business, first full year of business, I think he said there was about 130,000 cryptocurrency transactions, because she was having, 250 transactions a day, crypto, not cash, not credit card, crypto,
Wow.
Bitcoin. So track all this through. And then she was using Bitcoin with her vendor, Blue Bunny Ice Cream, to
Pay for her supplies.
to pay for her, her supplies at the end of the month. But consider this: at 9 o'clock in the morning, Bitcoin is worth $30,000 a coin.
Mhm.
At 9:05, it's 30,001. At 9:10, it's 29,990.
Yeah.
And she just bought $5 of that, a different amount of Bitcoin each and every transaction, and that changes all the time. So that's the cost basis of that $5 purchase. Then you got to figure out, well, when I sold that 0.0012679 Bitcoin that had a cost basis of this, when I sold it, it had a different 120 to 130,000 transactions that have to be reported on her business tax return.
So if you're her accountant, how much are you increasing your prices on that one?
Oh, that's not, I mean, we're talking thousands of dollars. Now, she's set up with the wallet holder that a lot of that's going to be done, and I'm going to get some summary information. I'm going to attach a PDF to the tax return. We're going to file electronically. I'm going to put some summary information. So a lot of that's going to be kind of handled from the wallet company. But Congress, this is the way of the world that we're going, potentially. It's, other than FTX, that's a different issue.
Yeah.
But
Yeah.
so, we have some of those issues that we're going to see more things that come out about virtual currency. And then business audits are going up. They're going up. And if you've got higher income, higher chance of getting audited. So
Wow.
Put that out there.
So interesting that it's that 100 to 200,000, that's the largest chance, and then it dips down a little bit. Is that just because there are less people making that larger amount?
And they typically hire professionals.
Ah, okay.
Whereas the ones making 100 to 2,000, 100 to 200,000, yeah, they're cheating. They're writing out by all kinds of stuff. And it's literally, they look at audits and here's where the most errors are and they line them up that way. So
that, are you, I don't know how close you are to done, but I'm
almost done.
I got a couple of questions.
Okay, hang on just a second. So a little bit of humor or not, the IRS equals theirs. Put the IRS together and it's theirs. And then, so yeah, during the audit, he actually refers to his yearly income as, get this, his money, because they think it's theirs. And then, yeah, there's just, this is similar. We already talked about most of this stuff, just kind of a recap.
Love it.
And, you know, the IRS, thank you for coming in on Christmas Eve, Mr. Claus. I hope it wasn't inconvenient. Welcome to the IRS. All right, what questions you got?
All right, I got a couple of questions. All right, so you talked a little bit about the $600 threshold for reporting an income, right?
Yep.
Earlier on.
Yep.
And I was reading an article that was very high level, just about the trouble that people might have with Venmo or Cash App. So small businesses who've been taking payments using Venmo and Cash App, right, are now going to get. So my question is, it's not just a per transaction at that point, is it? I mean, I guess this is where I'm looking for you to.
This is $600 for the year.
Yeah.
If you receive $600 during the year through Venmo, Cash App, everything else, you're getting a 1099K. And here's part of the problem is you got 3 roommates renting a house, one pays the bill and then the other send it through Venmo. Yeah, that person's getting a 1099K saying they got income.
So how do they handle that? Because that's not necessarily income.
It's
right.
not.
And here's it's interesting that you brought that up because I hadn't even considered that. But as I take Venmo, Cash App, mostly from my children paying me back loans that they've borrowed through Venmo and Cash App. But so if you've got a small business owner, especially a service-based business, a salon or something like that, where they're doing a lot of these transactions, people don't really carry cash anymore, right? And so they'll pay using Zelle or Cash App or Venmo. And then you've got a kid paying you back because they asked you to send them $100, so that's a mess.
Yes. It's a mess. And that small business owner is going to have to track every transaction because they're going to have to report on their tax return that 1099K amount of cash received through that service.
And now I'm guessing that the services are just going to send you a statement for the year and not an itemized transaction.
Correct. Absolutely.
Right. So it's going to be on you
is.
to sort them out.
Correct. And that business owner is going to have to track. It's their responsibility to track what is income and what is not. And then there will be a way. I mean, there's not a great way, but there's a way, and not each accountant, but I've heard 3 different ways of reporting that non-income cash received on the tax return. And so, yeah, that's what I'm talking about when that $600 small business owners, where it's mixed in with reimbursements and everything else. Yeah.
Well, I guess even outside of small business owners, anyone who's taking and is going to receive that income.
Oh yeah. Not just small, but the small business owners have a unique problem in that some of it is income.
Right. Yeah.
Whereas, if I'm just getting reimbursed from my roommate, well, I know none of it is. And so,
yeah,
and so the accountant knows how to do that, but you got to have documentation on the other stuff from.
So what's your big tip for that? So obviously it sounds like a hot mess. And if somebody listening to this or watching right now,
actually do bookkeeping on a routine, on a weekly, monthly basis. Do the bookkeeping.
That wasn't the answer I think we were all looking for, Jim.
That's the answer.
No, I think that's really smart. That's
So,
a great,
or
that's a great.
hire a bookkeeper to do this so
Yeah.
that not only is that taken care of and you don't have to deal with it, and you can deal with focusing on growing your business
Yeah,
and being successful and making money, and let somebody with the skills that knows how to do it take care of that. And
Great
then they
point.
can ask you those questions. But not only that, then you have good information that you can make good decisions to grow your business and be more successful.
great point. Awesome point. You brought up earlier, the different types of entities. What would be the number one reason why somebody would switch from an LLC to an S corp or vice versa, just in general? I know you said it's very specific, but a question popped up, and so I wanted to make sure that gets answered.
Okay, so let me be just a little bit clear with kind of LLC S corp, because it's confusing, and hopefully I can explain it. So
Yeah.
there are legal entities that are structured under the state, in this case, the state of Arizona, where we're at, for legal purposes and legal liability.
Mhm.
Then there are tax entities that the IRS looks at, and they're not the same.
Okay,
So for legal entities, you've got a sole proprietorship, you've got an LLC, you've got a partnership, and you have corporations.
Mhm.
Those are the legal entities. For tax entities, you've got sole proprietorship, partnership, S corporation, and C corporation. I mean, there's some business trusts and weird things out there, but those are the main things. So there's no such thing as an LLC tax return. There's no such thing as an LLC tax return.
Okay.
What an LLC does is you get to pick how you want to be taxed. If you don't pick, the IRS picks for you.
Oh,
And do you think they're going to pick in your best interest?
no.
So the default, if there's one member in the LLC, is a sole proprietorship. And the default, if there's more than one member, is a partnership. Sole proprietorships I like. For me, it basically comes down to, I want to save self-employment tax. And so I'm going to switch my LLC. It's still an LLC for state legal purposes, but then it's a one-page form with the IRS. I'm going to elect to be taxed as an S corporation.
Got it.
It's actually how my entity is. I'm an LLC taxed as an S corporation.
So when you have your taxes filed, your accountant should be giving you that advice as to how you should file your taxes?
Yeah, but once you elect S corporation,
It's
you're
forever.
there. You can't go back and forth.
Got it. Okay. Awesome.
You
Last
can go one
question.
way, but not the other. And generally for me is, if your income is under $75,000, stay as a sole proprietor. If or a little bit less than that, but once you hit about 70, 75,000, 80,000 of net income, yeah, you want to switch to an S corp.
Got it. Great tip. Last question. I know we're running the top of the hour here. But this question came in. What are the most common deductions that small business owners miss? And then the reverse of the question, what are the things people try to deduct that most commonly they try to deduct they shouldn't?
Yeah, so the ones they miss, mileage,
Mileage.
and home office.
Oh, got it.
And home office is critical for a small business owner, because mileage is, you only get a write-off business mileage. You don't get a write-off personal mileage, and commuting is personal, not business. So going from your home to your first business location of the day is a commute.
Oh,
That's the commute. So if you're going from your bedroom to your home office down the hallway, that's the commute. Then if you leave your home office and go to a client, get lunch with a client, you go somewhere else, that's all business miles. But if you don't have a home office, then your home to the first business location is that
freebie.
drive.
Got it.
And so mileage is really dependent on having that home office. And that's really the big thing that people don't think about, and you got to document some of that stuff. Whereas for a lot of small business owners, you know, if you're traveling to clients, you're a real estate agent, you're whatever, you're traveling, it's a big deal. I mean, it's 62 cents a mile or 62.5 cents a mile.
Yeah.
And you know, you drive 10, 15, 20,000 miles. It's a huge deduction that people, the home office isn't, you know, $800, $1,200 for the year.
Yeah.
It could be more depending on the situation, but that's not the big deal. It's the mileage. And then people writing off cable as part of their
Cable
internet,
television.
cable TV, cell phones for, you know, their aunt and uncle and their kids that live in a different state, but they're on their plan.
Oh,
Those telephone, it's postage, office supplies, travel costs that they are not really business, but they run them through the business.
got it. And so my own follow-up question there is, what are the zingers? Does in an audit, what's going to get you popped if you do some of those dumb things?
Oh, they're going to look at them. If you get audited, they're looking at them. Those are the big hot items.
Got it.
You know, yeah. And then the other thing they're looking at is if you have contract labor.
Ah, okay.
Those are the big things.
Got it. So if you've
Right
got people
now.
regularly working for you, they're probably employees, so pay them as such,
Yeah.
right? Pay the
Yeah.
taxes.
Yeah. Pay
Right?
the taxes. Yeah.
Got it. Got it. I'm hearing you loud
Exactly.
and clear. Well, hey, Jim, I want to thank you so much, so much for coming to spend today with the Surge Group and everybody else who's joining and listening to the replays. What I want you to share with the folks is, first of all, who do you work with? If somebody wants to reach out and work with you, how can they self-identify if they're a great person that needs your assistance?
Yeah. The best way is email me here at this email address, jchaston@cscpagroup.com.
Awesome.
Reach out that way. And we'll, you know, in my office, we got 10 people. So, you know, we can certainly take care of you. You know, different people have different specialties. And we focus on that. So we've got some good resources. You can reach out to me that way, and yeah, we'll get you taken care of. Our biggest thing is making sure that, you know, business owners are taking advantage of what Congress allowed for you as a small business owner. Small business still makes up 57% of employees in this country and just over 60% of GDP. That's small business.
Wow.
And so there's a reason that there are opportunities for small businesses to take write-offs. It's not a loophole. It's to promote our economy, which is, again, the majority is small business and small business owners.
That's great. Is there any specific niche that you work best with, or are you just small businesses your jam?
Yeah, so my 32-year experience, professionals, so whether that's doctors, lawyers, real estate agents, engineers, architects. I have a ton of professional services experience. I work with restaurants. I don't necessarily, I'm going to say this out here. I don't really like them because they don't see the value in it, and it's real. Restaurant accounting is difficult. There's a lot to be done to give them good advice. However, I work with a bunch, and I can certainly help you out. Construction, specialty contractors, general contractors. I've done a lot of work with that. I was actually the CFO of a construction company that did government jobs and dealing with all of those issues that those of you, if you're in construction, have government jobs and having to deal with prevailing wage and all of that stuff and those filings, we've done that. And I work with a lot of non-residents, so Canadians that have property down here, trucking, interstate trucking. We've got specialty there. And then retail. I mean, retail, yeah, ton of retail over the years. So I don't do manufacturing.
Got it. Okay.
So I kind of stay away from that and some, but outside of that, yeah, we help a lot of small business owners. And so what we do is if, we work with businesses up to about 25 million of revenue and up to about 100 employees is our niche. Once you get above that, we'll refer you to a bigger firm that deals with more of those issues. And so that we can focus and be the best that we can be on the smaller businesses.
Got it. Well, thanks. It sounds like you're a Jim of all trades. It's just
Yeah, a lot of that. And I'll leave you with one last joke. Accountants are great lovers. We're great with figures. So there you go.
So good, Jim. Thank you so much for hanging out with us and giving us there was some real juicy information in that. And I could count 5 tips alone that could save somebody a big chunk of money if they handle it by the end of the year. So thank you so much. And hopefully we get you on talking about some things that are, a little bit more, a little bit less penalty worthy. Maybe first quarter of next year, we'll do another little workshop. What do you think?
Sounds great. Let's do it.
Awesome. Thanks, Jim. You have a great day, and everybody have a great, happy holiday season. And we'll see you on the flip side. Bye.
Thanks.